Hello, very good dear subscribers, and welcome to a new video on the channel. Today we have the special video reviewing my portfolio starting from €0 with you. Get ready to discover my second pick in June. As always, first I would like to analyze a little about the evolution of the YouTube channel and how I see it in a couple of months. As you can see, the evolution during this last month has been negative since we grew less than I expected in the daily number of visits, and we have experienced a high decrease in daily new subscribers and visits. Maybe is due to my inactivity only uploading one video this month. As a result, this month we have not reached the goal of reaching 4,000 subscribers. So for this month the goal will be to reach 4,000 subscribers. Do you think we will make it? The evolution of the investment made at the beginning month has been positive, as it has grown more than 2%, but in overall the portfolio also has performed in a poor way with almost 2% downside. As is a special video in order to cover my portfolio transfer to Interactive Brokers as I mentioned in the past video, now I will be adding a company that I don't have in my portfolio. The company would be the first British company in my portfolio, Diageo. I will be analyzing both Molson Coors beverage from the US and Diageo and explaining why I chose Diageo, so let's get ready. Let's start by checking the dividend safety. We have the free cash flow payout ratio for Diageo above 80%, while Molson Coors has a little bit lower ratios all the years analyzed with a payout ratio below 50%. Looking into the dividend growth, Diageo has a compound annual growth rate over the last decade around 3.5%, while Molson Coors has a lower dividend growth of almost 1.5%, so despite having a lower payout ratio, the dividend growth for Molson is lower, indicating a more conservative dividend payment policy. Regarding dividend yield, currently both are far above the 5-year average, and it is to be mentioned that this situation can be due to the momentum of the alcoholic beverages sector. That is suffering downsides on the revenue during the last few years. Continuing with the evolution of the revenue and earnings, for Diageo was at least what it is expected to be in a defensive company with a compound annual growth rate since 2017 of 5.5%, above the inflation rate. However, for Molson Coors the evolution is completely flat, so doesn't have enough power to increase their revenue via increasing the price or volume. Now, if we look at the evolution of free cash flow margin over the last 5 years, here Molson Coors is around the average with a metric value around 10%, while Diageo has had a huge downside from values above 20% to 10% to 12% during the last 2 years. This situation of lack of growth is fully reflected looking at free cash flow yields, since both are above 5 years average, but Molson Coors is clearly above Diageo with values over 10%. As I mentioned in my previous videos, I want to make investments in companies that make buybacks. In this case, both have a buyback program. However, the amount of shares outstanding is almost the same since 2019, and it is to be mentioned that during 2022 Diageo spent around $2 billion in buybacks, so almost 60% of their free cash flow when the stock was in all-time highs, meaning a bad capital allocation in the past. The price/earnings ratio is a good indicator to check whether a company is undervalued or overvalued, in addition to a fair value analysis. Both are far below the 5-year average forward price-to-earnings ratio, but there is a clear difference between both due to a lower growth expectation in Molson Coors in the near future, having a ratio around 10 when the industry average is close to 15. So it is a sign of an undervaluation when we look at history, but maybe the valuation is the correct one looking at growth expectations of the industry. Moving on to shareholder yield, here the difference between both is more clear since Diageo is above average at 2% yield, while Molson is close to the average at 10% yield. So whereas Diageo can be indicating that it is more active in regarding shareholders through buybacks, dividends or total debt reductions, Molson is increasing this metric due to the huge downside of its price. Additionally, looking at the financial health, both have higher than expected net debt, close to 5.5 times free cash flow Molson Coors and to 8 times free cash flow Diageo. Here is when we can see that the repurchase of stocks of Diageo during 2022 was not a good decision and a reduction of its debt could be done. Once most of the important metrics have been analyzed, why did I pick Diageo over Molson Coors? The answer's pretty straightforward. Sure, Diageo has shown stronger growth, but also more ambitious valuations than Molson Coors. But here's the edge. Diageo is currently trading at an attractive valuation too, and still dominates globally in the alcoholic beverages with higher margins. I don't want a company that at least doesn't grow inflation, and since I don't have any company in the UK, which means having an investment also in pounds and a currency diversification. Now, we enter the interactive broker and carry out the operation, looking for the DGE ticker to buy the stock in London Stock Exchange. Remember that I will always try to make a purchase in order to have a commission less than 1%, and here in interactive the commissions are 35 cents per trade. I made 2 Diageo trades, the first one on March 14th at the price of £20.71 and bought 10 shares, while the second one was made on 22 of May at £20.80 per share and I bought 20 shares. So, it represents a total investment of £625 and a commission of £5.25, which means a commission of 0.84%. Well, we go on to write down the purchases made in our Google spreadsheet. So I put the date on which I made each purchase, Diageo's ticker, and finally I need to look at the euro to pound sterling exchange rate because its price is in pounds and I want to reference my investment in my local currency. As you can see, it gives me a total of €750, adding the €6.29 fee. Now let's move to the position sheet and placing the ticker in the first column. It automatically adds the number of shares and the average price per share. We add the consumer defensive sector reference in the column, and as you can see we have more than 10% downside during these 2 months because some of the industry companies announced a huge growth deceleration in their guidance. Also is a modest position of my portfolio with more than 3% allocation, and this investment will allow us to reinvest 1.08 shares annually via dividends. So we have the second company in which I can buy at least 1 additional share annually after Vici Properties. As we are not already in the month of July, I will leave the monthly upside or downside for the next video on the first Friday of July. This has been all for today, dear investors. A pleasure, as always, to receive your great support. Remember that these videos are not investment recommendations and it is necessary for each of you to do your own analysis and consult a financial expert if necessary. If you liked the video, don't forget to subscribe, hit the like button and activate the bell so you don't miss any of my interesting videos. Thank you for watching the video, and until next time.